Have you ever actually consulted a chatbot like ChatGPT for financial advice?
Oh, I mean, I think a lot of people have.
Right, because over half of adults in the US and the UK already have. They're bypassing human advisors completely.
Which is wild when you think about it.
It is. I mean, we are potentially looking at a world where AI use surpasses actual human financial advisors. So, okay, let's unpack this.
Yes, let's do it.
Because the mission of our deep dive today is to find out if this AI-generated financial advice is, you know, actually any good over the long run.
Right, because that's the real test, not just a quick tip, but long-term wealth building.
Exactly. And we are diving into this fascinating March 2026 paper by researchers from MIT and Stanford. It's titled AI Financial Advice, Supply, Demand, and Life Cycle Implications.
Such a great paper. The methodology they used is just incredible.
It really is. They didn't just type a few generic questions into a prompt box, right? They
Yeah.
surveyed 1,000 U.S. adults to get the exact, messy, real-world prompts that people actually use.
Yeah, they wanted the raw data, the authentic human demand side of the equation.
Mm-hmm. And then they fed those exact prompts to frontier models, specifically GPT 5.2 and Gemini 3 Flash.
And here's the kicker.
Yeah.
They didn't just look at the text responses.
Right. They ran a massive simulation. They simulated what would happen if you strictly followed that AI's advice for your entire life, from age 22 all the way to 89.
Facing real-world chaos, too. Job losses, income shocks, stock market crashes.
Yeah.
The works.
Exactly. But before we get to those 40-year results, we really need to understand the immediate conversation, like how we actually talk to the AI and how it responds.
Well, the survey showed that people are mostly focused on the basics. 59% of the prompts were about budgeting.
Okay, that makes sense.
Yeah, and 58% were about investment assets, and 47% just asked about income.
So just day-to-day survival and basic growth.
Right, but how the AI responds is where it gets really interesting. It actually amplifies those concerns.
Oh.
Yeah, there's a 0.71 correlation between the prompt topics and the advice topics. It's an echo chamber, but it also introduces these weird, unprompted fixations.
It's a liquidity thing.
Yes. The liquidity thing is such a perfect example.
I mean, only 6% of the human prompts even mention liquidity or an emergency fund.
But the AI,
Yeah.
83% of its responses emphasized it.
It's just constantly nagging you to build a cash buffer, even if you didn't ask.
Exactly. And it gets weirdly specific with products, too. I mean, fewer than 3% of humans name specific stock tickers in their prompts.
Right? We just ask general questions.
But the AI routinely recommends branded products. It tells you to buy Vanguard, iShares, and it even pushes crypto tokens like Bitcoin or Ethereum.
Completely unprompted. It's like going to a doctor with a slightly sore knee, and they not only diagnose the knee, but they immediately start aggressively recommending a very specific brand of running shoe.
Yes.
And then they tell you to build a bunker for the apocalypse.
That bunker analogy is spot on. It is a highly opinionated, hyper-cautious product pusher.
So, okay, we know the AI gives this hyper-cautious advice. But what happens if you actually follow it for 40 years? Does it make you rich or does it ruin you?
Well, let's look at the good news first. Because surprisingly, as an overly strict savings coach, it actually works.
It really does. It moves people much closer to optimal economic behavior, which economists call life cycle theory.
Right, the benchmark for how we theoretically should behave.
Which we don't at all. I mean, looking at the status quo of the survey respondents, 1/3 of them hold zero equities.
Zero stocks, which is terrible for long-term growth.
Yeah, and over 20% have less than $10,000 in financial wealth. But if those same people followed the AI in the simulation,
They hit near universal stock market participation, over 99%.
and virtually everyone built a substantial savings buffer by age 30, the AI just forces you to smooth your consumption.
It makes you save heavily during your working years and spend down slowly in retirement. It usually recommends an equity share of around 65%.
And then gradually brings that down after age 45.
Right. And when the researchers calculated the AI's structural preference parameters, basically mapping its brain, they found a risk aversion level of 5.2.
Which is pretty standard, right?
It is perfectly standard.
Yeah.
But the intertemporal discount factor, the beta, was 1.044.
Okay, wait. Isn't that absurdly high?
It is mathematically anomalous for a human, yes.
Because it means the AI values the future more than the present.
Exactly. It applies a negative discount rate.
Yeah.
The models aren't formally optimized to make us better investors. They could just validate our bad habits to keep us chatting.
Right.
But the fact that they inherently act as a commitment device against undersaving is a huge win.
Wait, so the AI is basically that hyper-frugal friend who refuses to go out for dinner because they are terrified of being broke at age 85.
That is exactly what it is.
It's acting like a paternalistic coach.
It is. But that paternalism has some serious flaws when things get complicated.
The bad side of the AI advice.
Right. The AI relies massively on simple heuristics, just mental shortcuts.
The round numbers. Over 30% of its savings rate recommendations are just in multiples of 10%.
Yeah, save 10%, save 20%.
And 34% of the savings amount recommendations are in multiples of $5,000.
It's just regurgitating popular internet finance blogs. It's not doing bespoke math for you.
And in retirement, it rigidly sticks to the famous 4% withdrawal rule over 85% of the time, regardless of what the stock market is actually doing.
But the biggest failure, the most dangerous one in the simulation, is the job loss scenario.
Oh, man, this part is wild. So the researchers simulated an unemployment shock where the user's income drops by 50%.
Right. And remember, the AI has spent years forcing this user to build a massive emergency liquid buffer.
So you'd think it would say, hey, use the buffer.
But it doesn't. It tells the user to instantly slash their consumption and lifestyle by 50%.
It completely ignores the buffer. It just panics.
It completely panics. It just looks at the immediate income drop and says, cut expenses. It fails to synthesize the historical state of your bank account.
Which also explains the passive drift issue.
Yes. Passive portfolio drift.
Like, if the stock market shoots up, a human advisor would rebalance your portfolio. Sell some stocks, buy some bonds, right?
Restore the target risk.
But the AI doesn't do that. It just lets the portfolio drift. It's treating your life savings like a slow cooker crock pot. Just set it and forget it, rather than actively steering the ship when the weather changes.
It only focuses on where to put your new savings, the cash flow. It ignores the wealth you've already built.
So it's acting like a rigid blog post instead of a dynamic thinker. But is this the model's fault, or is it our fault for writing bad prompts?
That is the million-dollar question. Supply versus demand.
Right. What if we talk to it like a trained economist?
So the researchers tested this. They replaced the messy human prompts with a highly structured academic prompt.
Right. They explicitly laid out life cycle planning duties, U.S. tax laws, expected stock returns, strict budget identities.
And it worked, mostly.
It fixed the panic mode.
It did. The AI stopped using simple round number heuristics. And when that 50% unemployment shock hit again, the AI finally told the user to tap into their emergency savings.
So it kept their lifestyle relatively smooth instead of slashing spending. That is incredible.
It is. But the academic prompt did not fix the passive portfolio drift.
So the AI still refused to actively rebalance existing assets.
Yeah. So while better prompting, the demand side, can fix the consumption logic, some limitations remain hard-coded in the model's structure, the supply side.
Here's where it gets really interesting for you listening, though. Simply changing how you structure your question to the AI can literally save you from making panic-driven lifestyle cuts.
Absolutely. You have so much power in how you prompt.
But the researchers found that the advice also changes drastically based on who is writing the prompt.
The demographic disparities. This part of the paper is incredibly consequential.
It really is. They split the simulated lives by user demographics. Let's look at financial literacy first.
Right. Users who showed low financial literacy in their prompts ended up with about $45,800 less wealth at age 60.
That's a 4% drop. And why? Not because they saved less.
No, it was because the AI recommended lower equity allocations to them, fewer stocks.
And we saw the same thing with AI experience. People who had never used AI for finance before were told to save less.
Which resulted in about $99,700 less wealth at retirement, a 5.7% hit.
Just because they were a novice.
But the gender gap is the most striking finding.
Yeah, women accumulated roughly $59,890 less wealth at age 60 than men.
A 4.1% penalty. And again, entirely driven by the AI recommending lower, more conservative equity shares to women.
Okay, I have to push back hard here. Wait, so is the AI making a smart, nuanced assumption that women might have different latent risk tolerances based on actuarial statistics? Or is it just lazily inheriting sexist stereotypes from its training data?
Well, if we connect this to the bigger picture, your pushback is completely valid. The normative implication here is completely ambiguous.
Oh, so?
Well, they decompose the gap into demand versus supply. About two-thirds of this gender gap is demand.
Meaning the words people use.
Right. Men prompt the AI using aggressive words like stocks and rebalance, while women in this survey data prompted using words like debt, CDs, and safe.
Okay, so the AI is just reacting to the word safe. That makes sense for two-thirds of it, but what about the other third?
The remaining one-third is supply. It's the model itself. The researchers took completely gender-neutral prompts, exact same financial situation, exact same numbers, and secretly injected "I am a man" or "I am a woman" at the beginning.
And what happened?
The LLM intrinsically gave the woman label a lower equity allocation for the exact same financial reality.
That is wild.
And traditional human advisors actually show this exact same gender bias in empirical data. And now we are watching AI replicate the exact same human flaw at scale.
It's absorbing our biases and feeding them back to us as mathematical authority.
Precisely.
So pulling all of this together, the AI is an incredible tool. It can move you toward better financial health, and it acts as a very strict savings coach.
It gives people saving and investing who otherwise wouldn't.
But it relies heavily on internet blog heuristics. It completely panics during a job loss unless you prompt it, like an academic.
Right.
And it harbors demographic biases that can literally cost you tens of thousands of dollars over a lifetime.
The stakes are incredibly high.
So the biggest takeaway for you listening is that you are the one in control of the prompt.
Yes, you are the fiduciary now.
The quality of the output absolutely depends on the structure and rigor of your input. You can't just hand over your data and check out.
You have to actively manage the algorithm that is managing your money.
Exactly. And that leaves you with a pretty wild new angle to ponder. Think about this. If an AI adjusts its financial advice based simply on the demographic label you provide, at what point is the AI no longer just advising you, but actually defining your risk profile for you?
Oh, that's a deep question.
If a machine assumes you are risk-averse just because of your gender or background, and you follow its advice, does it become a self-fulfilling prophecy where the algorithm permanently shapes your financial identity? Keep prompting carefully, everyone. We will catch you on the next deep dive.